Good morning and welcome. My name is Matt Leatherman. I'm Managing Director and Head of Programs here at FCLT Global. FCLT is a nonprofit research organization whose mission is in our name. Our mission is to focus capital on the long term in support of a sustainable and prosperous economy. You are in a panel session called Receding Horizons, Long-Term Strategies Amid Uncertainty. We're excited because this panel marks the release of FCLTCompass 2022. This is a moment of pride for FCLT Global. Compass is our flagship product. Its purpose is to provide an annual benchmarking tool that tracks long-term investments on a global scale, measuring the investment horizons of global savers, asset classes, and companies. It's also a practical product. This product informs FCLT's other work with information about opportunities to find and challenges to manage, and we hope that it can do the same for you as well. We have an excellent panel today to help us launch Compass, one that spans the world and different types of organizations in the value chain as well. We have Jean-David Tremblay-Frenet, or JD, the Chief Economist from Alberta Investment Management Company. Welcome, JD.
Thank you.
We have Michael Metcalf, Head of Global Macro Strategy at State Street Global Markets, or SSGX. As a quick aside, we'll also say that SSGX has been a data partner for Compass, and we're very grateful for that as well. We have Laura Sarlo, who is an emerging markets portfolio manager in global fixed income for Liberty Mutual Insurance. As an aside here as well, Laura has alerted us that her voice is weak this morning. And so we're going to make the most, Laura, of your contributions as we can and otherwise spare your voice as we're able as well. And then last but certainly not least, we have Alan He, who is the principal author of FCLT Compass. So this is a moment of celebration for our organization, but also for Alan in particular. Without further ado, let's just dive in. Alan, can you kick us off? What is Compass and what did you find this year? Alan, we don't have your audio coming through.
Is this better?
There we go. Now we have you.
Perfect. All right. Thanks, Matt. And a very good morning, good afternoon, or good evening to my fellow panelists and everyone online today. We are incredibly proud to launch the 2022 edition of FCLT Compass today. And overall, the research of Compass traces investor savings through various asset vehicles to companies that deploy it in support of business and economic growth. Along the way, we seek to answer this key question of how much money is managed in a long-term way. We do this by attaching investment time horizons to each segment across the investment value chain to compare gaps in allocations and intentions. This year, the theme has been one of receding time horizons. It's the first year in our study that investment horizons shrank for all of our main groups at once. Saver time horizons shrank significantly, led by high household consumptions and lower savings rates in major developed markets like the US and the UK. Likewise, corporates also held on to a fairly significant amount of cash this past year, instead of allocating that capital back into R&D, CapEx, and other forms through the company. This, as a result, shortened their investment horizons as well. Finally, asset class horizons also shrunk slightly, with higher turnover leading to lower investment horizons from primarily the fixed income asset class. On a high level, we saw three key themes from the past year. First, one of economic decoupling and divergence, a trend that we're seeing play out across several markets like households, equities, and corporates. Second, we had a deeper look at asset class correlations and note that there's been a breakdown in correlation specifically between equities and bonds. While this is not necessarily a new phenomenon, past year signifies a pretty significant shift in portfolio allocations, especially towards the private markets themselves. Third, on the corporate side, it's very much a balance between resilience and efficiency. Coming out of the pandemic, companies are holding on to much more cash, but are they being more strategic with the uses of that cash, like, for example, to the energy transition, solving some supply chain issues. My fellow panelists and I will also look to touch upon these things, as well as some of the other key themes that we saw from Compass this year.
Thanks, Alan. Before we get too deep into the details here, let's get some initial reactions. Laura, I'll give you the microphone first, and you can be efficient like we've talked about with any ideas that you want to add. And then JD and Michael will ask you to unpack further. But Laura, let's go to you first.
Sure. Good morning, good afternoon, good evening, and apologies for my terrible voice. I think that Alan's report on the findings from this Compass research are quite interesting this year. I think it reflects the kind of structural and cyclical uncertainty that markets and companies and households and investors are all wrestling with this time. I think, there's always uncertainty in markets, but what makes this rather unique is that confluence of very high structural uncertainty as the economy comes out of the pandemic, and then the cyclical dynamic around inflation and growth as we think about next year. So for us as investors, really our key priority is to build portfolios that are resilient under as many different scenarios as we can imagine. And that's definitely not an easy task right now.
Michael, I'd like to draw you in next and focus especially on the concept of uncertainty that Laura put on the table, resilience, and then also parlay in another word, fragility, because I think you have some interesting thoughts there. Could you give us a general reaction to what Alan said, and then also perhaps some specific thoughts on the themes of uncertainty, resilience, and fragility in the markets today?
Yeah, of course. And look, I think most of us would be very happy to see the back of 2022 because it's been a a confluence of, and I think the it's been a multitude of shocks, most of which have kind of come through inflation, but it's just been the confidence in forecasting in particular, I think has been shaken quite significantly. And even though we're in the midst of kind of repairing that, and we don't talk about transitory inflation now, we talk about structural, and we're going to talk about the energy transition a little later on. It's understandable having not anticipated some of these structural shifts, because this is a very unique recovery that we're seeing, but there's also some structural shifts underlying it. And so you perhaps no surprise that you've seen this shortening. I mean, the interesting thing about the report is that you see it across every sector. It's very consistent. It isn't just markets that are being short term. It's households and it's corporates. It's across the board, which I think is very interesting. The other kind of curious thing just to highlight, though, of course, is that right now there's some terrific valuation opportunities in some asset classes for really long-term investors. It's just a question of whether we're brave enough to go back out on that longer horizon. And just in terms of fragility, one thing I would kind of note is that, so look, obviously there've been some very public accidents in markets, whether it be in crypto assets or in the UK gilt market, for instance. But in general, actually, financial markets as a whole, I think would probably say that have actually performed reasonably well. And actually, one of the measures we have of fragility that you alluded to, Matt, looks for a symptom of financial crisis, which is that you can explain market movements by a very small set of factors. And it's really interesting. It hasn't really triggered. And so even though we've had these dramatic moves in interest rates, that certainly this time last year you would never have envisaged the kind of moves in rates that we've had. Actually, so far at least, the system is holding up relatively well, and certainly the banking sector is showing a good degree, I think, of resilience given the uncertainty in market moves we've had elsewhere. So there's one positive point to end on.
Sure, we appreciate that. JD, thoughts from Edmonton?
Yeah, thank you, Matthew. Well, I think this year has been one of a kind, truly, on a number of counts, as my other panelists, esteemed panelists have noted. And really, it's a case of now, at this particular stage, long-term investors will have to take stock of what has happened in the last couple of years and then adjust how they actually invest. There are some structural trends that we're going to be discussing perhaps more in details, during this seminar, this webinar, like structural higher inflation, for instance, and friendshoring or reshoring as well. And so that fractured world order makes it for very interesting times to invest. One thing that I've noted in the report itself is that, it seems like a few key countries have shortened their investment horizon, according to the report, such as the UK and the United States. But I'm still taking some comfort that for the most part, countries seem to be like investors across a number of countries seem to actually lengthen their investment horizon. So this is good news.
Thank you, JD. I'll add a little bit to that tidbit. It's true the US and UK have shortened a little bit, but our friends north of the border in Canada have lengthened it just a little bit as well. And so we're looking for some leadership there. Alan, Michael said a word that doesn't come up often in these conversations. He talked about households themselves, not just owners, managers, and corporations. And you know this, of course, as a colleague, but FCLT does our work so that savers and communities can benefit from a more sustainable and prosperous economy. What results does Compass offer for savers and communities?
Sure. I think for me, it's very much about what's next and a tale of two sides for households, savers, and communities. Those that have had high consumption over the past year and those that have tried saving a bit more over the past year. We've already briefly mentioned inflation, and I'm sure that word will probably come up many more times through the rest of this conversation. But what's interesting to note there is that consumption is also very high in those markets that JD has talked about, in the US, in the UK, other parts of Western Europe. And it's also high across the wealth spectrum as well. So not just high consumption among the high and wealthiest individuals, but across the spectrum. What's next as inflation continues to rise and as we enter potentially a recession and savings might tumble? I'm worried about those folks in the lower wealth bracket who continue to have high consumption. The second point I'll make here is that it also makes for fascinating contrasts for those who have accumulated a lot of wealth over the past year or two, like folks in the middle income class in China. Households there have, for example, chose to save up more of their savings, but it hasn't been towards traditional things that we've come to know, like the equities market. In fact, many folks in China believe that investing in the equities market is almost like gambling in a casino. They've allocated, from what we've seen in the Compass report, more towards real estate. They've held additional cash and perhaps even some shadow banking activities. It's interesting how these folks will get affected down the road in terms of the what's next, as well as inflation remains high. We've seen signs of the Chinese real estate market cooling, and as China's failed to open up fully, with cash and high inflation, that'll also lose its value. So it'll really remain to be seen what will become of these two trends as well.
Michael and JD, I've seen you both nodding along. We're about to find out how many one-handed versus two-handed economists we have in this room. But I'm going to ask you, I see that. Challenge accepted. So Michael, we'll start with you, and then JD, give you the next word, and Laura, wrap us up on this line of questioning. But Michael, I'd like to look for the long term, right? Compass looks a year back and provides rolling data in that sense, but we're always trying to also look on the long horizon. What inferences can we draw for savers and communities from the patterns that Alan has just laid out? And is there any further information that you can add from your work as well? Go to you first, Michael.
Yeah, and look, I think and there's been many studies on this, is that for household savers, the period that you live through really does affect your asset allocation. So, savers that lived through the Great Depression, that their risk appetite never came back for equities. And so, but it's interesting because I think post-pandemic, obviously the first step was generally to go back to equities because that was where the reflation came. But then this year has been a real check on that. and that you've had equities and bonds going down together, which has obviously been very difficult to figure out where you put your money going forward. I do think that the volatility and uncertainty that we've had will mean that savers for at least the near term are going to be quite cautious, and the kind of, I suppose, the good news now is that yield is back, and so look, obviously in China yield never really went away, but in certain countries yield and bonds weren't an option, whereas now especially on a kind of a longer term view, so if you're rather than a year, you're projecting forward 2 or 3 years, then actually returns in fixed income can be attractive again, and in many countries you haven't been able to say that for really quite some time.
JD, love to get your thoughts as well, looking to the long-term inferences that we can draw on things that you can add from your work. And then Laura, I'm going to draw you in specifically on that fixed income point. JD?
Yes, so indeed now the hurdle rate for investing has increased quite markedly in the last few months. And now you have to be a cash rate that is much higher than it used to be. Yep. So this will change a little bit as well, the types of opportunities that long-term investors are going to be seeking over the next little while. Definitely, as part of this, there's that notion of the fractured world order, which is going to bring some obvious consequences with respect to the energy transition, already that started in Europe in particular. But we're going to be facing a host of opportunities for going from gray to green over the next little while. And that's definitely going to be an underlying structural trend for the market and long-term investors. And so we're going to be looking forward to that type of environment. Lots of opportunities lying around the corner. And the last point I would make is that despite the fact that we are going to probably be living in a more fractured world order, as I've spoken about previously, I think that the end of globalization is greatly exaggerated at this time.
Thank you. I appreciate that point. We'll pick that back up in conversation in a minute. But Laura, let's go to you for a response on these fixed income points and anything else that you might like to add.
Sure. So I definitely agree that public fixed income has become attractive in a way that it hasn't been in the last few years. So I'll be interested to see in next year's Compass report if you start to see a shift in that sense, maybe in favor of public fixed income. I think there was some mention, Michael mentioned about the changes in inflation, and I think that's really quite challenging for everyone involved, right? The volatility of inflation. Now we're starting to see goods prices moving back down, right? But services prices remain an elevated component, and so the inflation volatility, right? Everyone can sort of plan if energy prices are going to be high or housing prices are going to be high, right? But it's the movement back and forth that really creates trouble for everyone in their forward-looking planning and in their ability to take a long-term time horizon. So that's why I think sometimes in markets, really the highest risk premium is demanded when you do have that kind of volatility. So, I'm curious to see if we can, obviously inflation is not transitory, but how much can we make progress on it so that it doesn't become something that every year people are thinking back and forth, and that markets are wrestling with that. And then the last point, I just wanted to pick up on something that you mentioned and JD mentioned, just the tremendous pool of savings in China. And as Alan noted, households there maybe have not always been as active in the equity market. Certainly your average household compared to other countries, right? But they have been quite large investors in the real estate market. And as Alan noted, that is really retrenching now. So that's a very large pool of savings that does need a predictable and hopefully a safe home. And so I think globally we've got these shifts in generations and in demographics and consumption patterns by demographics in major economies that are going to be a factor here for the next few years.
Yeah, thank you for that, Laura. I think it's particularly interesting the point that you made about the volatility of inflation and inflation projections. That's, I think, a really pithy and pointed explanation in part for why we see time horizons shortening, because of the uncertainty that creates. I'll say for everybody in the room, the attendees in the room in particular, FCLT Global believes, one of our reasons for existing, we believe that long-term focus is leveraged or that it's lost based on how well asset owners, asset managers, and corporations do their work together on behalf of savers and communities. So I'm going to draw you out about similarities and differences that we're seeing among owners, managers, and corporations. What patterns are we seeing, and how does it break down among these different nodes of the value chain?
Yeah, really important point. And we've seen through our research, and not just with Compass, that time horizons absolutely do matter, and can often be the friction points when it comes to the interactions between these three groups: owners, managers, and corporations. On a high level, I'd say we're seeing two things in Compass. One, in terms of similarities, as mentioned from the start, investment horizon gap between all three parties has shrunk this year. That gap has actually shrunk the intention to actual allocation gap. Now, the overall investment horizons has come down with it, but in that sense, there's a little bit of a convergence in terms of that intention to actual allocation. What we have seen that's slightly more challenging over the past year is that all three segments of the value chain face difficulties in terms of working together to ride out this post-pandemic turbulence, so we call it. Corporates, we've seen, have had indeed a renewed focus on resiliency, but there's a little bit of additional tension when it comes to communicating the fact that they're holding that extra cash to their investors, who might not view this as a positive all the time. Investors are getting it from both sides. They not only need to understand this corporate angle of resilience and accept it, they also need to balance their own investments, their own mandates between liquidity of their portfolio and return in such a turbulent environment. We've seen a little bit more focus towards the long term in terms of illiquid private assets, but how much illiquidity can a portfolio manager, can an investor really take? On the owner side, it's about holding the managers accountable to ensure that this ever-changing needs that we've seen over the past year of their beneficiaries' criteria are met. So, for example, we've seen with geopolitics, with the Russia-Ukraine war, with several ESG-related issues over the past year. These criteria, these needs are constantly changing. They also need to fulfill a purpose to these beneficiaries to deliver a sufficient return for example, their retirement fund. Mm-hmm. And all this presents a lot of different challenges, but I think the best way to probably describe this through one word is turbulence. And one thing that we'd like to use turbulence, and it's really akin to the flight metaphor. No flight is ever perfectly smooth. You can't just magically close your eyes and reach your final destination. There's always going to be turbulence. It's about how you work through it as a group that matters. And that's what I think should be one of the main takeaways here.
JD, let's go to you first. How do these trends look from inside an asset owner institution to you?
Well, I very much appreciated Alan singling out the issue of liquidity, because this is truly at the crux of how we need to manage portfolios going forward. We have been also managing portfolios, having that particular dimension at the back of our minds, but it's going to become increasingly important to balance how much illiquidity is enough in pension portfolios as well as in endowment portfolios. Now, given that very long-term horizon, in particular for endowment funds, but also for pension funds, generally speaking, the increase in allocation towards private investments is something that we're seeing as a continuing trend here. So lots of opportunities, even again, back to the energy transition theme, for instance. So this is where a lot of opportunities on the private side will originate going forward. So that's something that is sitting very high at the top of our agenda. Also, I guess that long-term institutional investors will need to find creative ways of accompanying corporates into the resiliency theme. And there are different ways of doing so, but definitely contributing to financing different ways that they can become more resilient over time is one thing. So relationship investing, for instance, on the private equity side, might come back to the fore, just as an example for that purpose.
I appreciate you saying all of that, JD. We're going to pick up the subject of resilience again momentarily, but I'll try to weave in relationship investing as a component of it when we do. Before we do, Laura, let me go to you from perspective inside the asset management function at an institution.
Yeah, so certainly exciting times, right? To JD's point, we're thinking quite a lot about liquidity. We're thinking about energy transition as a priority. We're thinking about, opportunities over the long run. Of course, we're managing on behalf of a property and casualty insurance company, right? So we're always quite focused on our liabilities and ensuring that we're generating capital in order to meet all of our liabilities. So, I think the improved return potential in public fixed income is something that we and all asset managers are looking at these days, and that's for me, managing part of the portfolios in that space. That's quite exciting. Hoping that we'll find more favor relative to some of the other parts of the portfolio that have seemed so much more interesting these last few years. So it's an exciting time in that sense.
Thank you. Mike, I'd like to draw you out. You, of course, work within asset management, broadly speaking, as well, but within a publicly traded corporation as well. Let me give you wide open remit. How do these trends look to you from the various places in the value chain that you occupy?
Well, so what I could do actually, so one of the things that is a feature of our research at State Street is that we're able to track investor behavior in a very aggregated sense across the asset management industry, and it's this is both good news and bad news for next year, I would say. So I think echoing JD's comments on liquidity, one of the most liquid assets, of course, is cash, and we've been monitoring cash holdings very closely throughout the pandemic and the recovery, and here's the story it sort of tells, is that very, very quickly when the pandemic struck, investors got very, very overweight cash very quickly, and they were very, very liquid, and that cash sat on the sidelines and then just has gradually gotten dragged into the market, and so that enabled a very constructive view of asset markets for quite some time, and then going into the start of this year, cash holdings were quite significantly below average, which maybe told you where the balance of risks was lying at the time. And if I look at it today, when we're all writing our 2023 year ahead outlooks, so here's the kind of puzzling thing. You'd think after the year that we've had and the kind of onus that's been put on liquidity, that cash holdings would be really high. They have gone up, but they've only gone back up to about the historical average, which I think is kind of curious. And so, and things like equity, and actually the corollary of that is that equity and fixed income holdings are also quite close to their long-term average. So curiously enough, I would say that investors are going into 23 with quite a neutral setting, which I think, given the common challenge that all these different stakeholders have, which is stagflation, still very slow growth and high inflation. Investors don't look to me to be that defensively positioned for it, which I think is a bit of a puzzle. It might be that they're being optimistic, but certainly don't think that next year is going to be much better simply because investors are underweight risk and overweight cash, because it doesn't look to us that they are.
In some respects, that's good news. When the market overall is optimistic, we can be optimistic.
That's true.
I like that.
Yeah, it's almost like it's a blank sheet of paper. So that's your archetypical two-hander there, right there. Yeah.
Sure. We're entering the back half of our time together. I'm going to take an administrative moment and then get back to some questions. We're also taking questions from folks in the room via the chat. So if you are attending today's panel and have a question for Laura, JD, or Michael, please put it into the chat and I'll do my best to work it in. Alan led us off at the beginning by identifying three themes that really came out of this year's Compass report. They were economic divergence or decoupling. They're a closer look at portfolio asset allocation, particularly for fixed income. And then there's also a balance between resilience and efficiency across the value chain. I'd like to probe each of those with a question now. I'm going to begin with the question of economic decoupling. This is particularly interesting to FCLT Global. 70 CEOs from across our membership tackled the topic of geopolitics and economic decoupling at our summit in March, a gathering that we had in New York in March. When polled, nearly half named reputation risk as the greatest concern in the geopolitical context, followed by a fifth who pointed to supply chain pressures and several others that added concerns about access to capital markets and data privacy or data governance. I'd like to hear from each of our panelists. If you've done your own analysis of these issues, you've previewed ours, what risks associated with economic decoupling strike you the most? And are there any that you think are overstated? Michael, perhaps we'll lead off with you.
Well, interestingly, in terms of the work that we've done, we've been looking at corporate communications and looking at the net balance of comments that are sort of favorable to onshoring versus offshoring. And I can tell you that certainly it was beginning to capture something around March when you had your gathering. But I can tell you since then that the metric has really shot it. And look, we only have data going back to 2015, but we've never seen a stronger balance towards sort of reshoring and anti-offshoring, if you like, on that metric. And so I think, at the micro level, as kind of news coming out from corporate communications, we've never seen such a strong tilt towards reshoring, which I think, absolutely captures this decoupling theme that you're talking about. And obviously has some implications for growth and inflation and the macro environment more generally, I think.
For sure. JD, you use this word onshoring as well. I wonder your reactions.
Yeah, I think onshoring and friendshoring is something that will take hold very gradually. And so that is partly why I've noted previously that the end of globalization is greatly exaggerated. Those types of moves, structural moves, in terms of reshoring your supply chain from top to bottom, is a very gradual process typically. And frankly, because all the countries that are involved, especially China, the US, Europe to a certain extent as well, they are really facing a march towards that friendshoring that is going to be quite complex. You can't just build new plants in different countries from one day to the next, etc. So it will take time. And I think that when people believe that growth will be duly impacted in a very significant fashion, like practically overnight, that is the market theme that is probably quite exaggerated. Now, that being said, that trend of onshoring definitely has a structural impact on inflation being higher as a consequence of that particular trend. So we're amongst other factors for inflation to be structurally higher over the next decade or so, or even longer than that. But definitely onshoring as an impact there.
So Laura, you do your work in fixed income, but in a particular part of fixed income, you work in emerging markets. How does all of this look from your perspective?
So I would, I'd agree with JD's point that, these things don't just happen overnight. And as much as we think about the pandemic as such a big driver, some of what we've seen in terms of diversification of supply chain was happening in the years prior to the pandemic because of the rising cost of production in China, and of course the trade stress that we've seen, which predated the pandemic as well. So
Mhm.
that diversification of supply chains is definitely already a running theme, and it has certainly garnered more attention coming out of the pandemic and thinking about resilience of critical inputs. So, but nonetheless, China is still the destination for 40% of the world's foreign direct investment. So while
Mhm.
we do see some uptick in investments going into economies like Vietnam, Philippines, and India, Mexico, other markets that you would anticipate will be beneficiaries of this kind of diversification, China is still, number one in terms of having the logistics, the infrastructure, and so it is challenging, I believe, for companies to really diversify. But certainly that marginal investment potentially is going to other places. And for me, focusing in the emerging markets, I think
Yeah.
it's an opportunity for different countries, right? So where will countries have the policy framework and the economic wherewithal to really capitalize on that? That may be uneven in different places as we think about it for the
Sure.
next few years.
Thank you. Alan, I'd love to get your reactions. How do these perspectives line up with what you've learned in Compass this year?
Right. So on a high level, they pretty much line up exactly as what Michael and JD and Laura have said, that this onshoring, offshoring risk isn't something that to happen overnight. And likewise in Compass, we've seen maybe small increments of that happening. Capital flow slowly flowing out of China with regards to inflows from the institutional investor markets. That being said, China is still by and large, as Laura said, one of the largest markets, especially in the emerging markets category. You don't just make capital disappear, reallocate it to other markets overnight, and it's also a very significant amount of capital as well. So all the things that Laura, JD, and Michael said, can agree with more, and correlates very well with what we see in Compass over the past year.
Sure. So let's stay broadly on the fixed income topic for a second and parlay it toward the theme, Alan, you drew out about a closer look at portfolio asset allocations. You know well as co-author with me that one of our longest standing lines of practical research pertains to asset allocation and risk management, beginning with a publication called Balancing Act, Managing Investment Risk for Multiple Time Horizons. This work is necessary because we realize that important financial and economic cycles unfold over different time horizons. Interest rates are a great example of this, but many investors haven't adjusted their models for expected return and risk management, even though fixed income prices vary differently over time from other assets. Here's the question. What do investors need to know today about fixed income as an asset class? And what do we expect from corporate issuers in this rate environment? Laura, I hope we're not overstressing you, but this question goes to you first. It belongs to you. What do we need to know today, and what do we expect from issuers?
Well, I would say yes. So from an investment perspective, right, public fixed income markets have become more competitive relative to other asset classes. I think issuers, right, some issuers have, as rates have gone up, have lost capital market access, right? I'm thinking of some of the lower rated emerging market economies that have not been able to issue this year. So we've seen more customers at multilateral facilities and the IMF. So I think broadly, everyone needs to plan for higher funding costs, right? So as I think about
Mhm.
emerging market sovereigns, that means making more room in your budget for whatever the debt cost will be over the next years compared to maybe what you were planning at the same time last year. And I think issuers are adjusting to the idea that rates will be higher. So maybe some issuers are trying to put off longer term issuance, right? Or have
Mm.
sought to kind of hang out and hold on
Mhm.
for a little bit and wait and see, and maybe it'll turn quickly, right? So I think 2023 will be, that period of kind of reckoning of whether okay, yeah, they might continue to move up. So we need to move forward with what our plans were, or there will not be a quick turn per se. And then something that I'm quite focused on is just market function. So we've had some bouts of market dysfunction, even in the risk-free rate and the treasury market. And so as we think about public fixed income becoming more attractive to more folks, and we imagine potentially more capital being allocated to those markets, will the market function hold up, or might we see some bouts of market, breakdown or pricing gaps in markets? That's something that I think
Yeah.
I'm paying attention to.
JD, we've heard the bottom-up perspective on fixed income here. You've had an entire career in asset allocation and portfolio construction. What does the top-down asset owner perspective on all of this look like?
Well, with the higher cost of capital, that is going to be a feature, very meaningful feature of the markets for a while. So it seems, piggybacking on Laura's comments, I think that because of what we've seen in public fixed income markets in terms of some of the risks and illiquidity in some of the key markets, such as the US Treasury market in the US, then one of the consequences is that actually the private credit market and private debt and loans is becoming increasingly a market where some of those corporates will seek to finance themselves. So that's one area where we are thinking that there's going to be a host of opportunities going forward because of what we've been observing in the public fixed income market, as an example. So something to keep in mind.
For sure. Thank you. Michael and Alan, I would like to give you both a chance to react openly to what JD and Laura have put on the table. Michael, we'll go to you first, and then Alan, your reaction as well.
Well, I mean, just echoing what Laura said about sort of funding costs and being careful and illiquidity. I think that the performance of the 30-year gilt in September and October, where I think at various points it was more volatile than Bitcoin, has served as a very sharp reminder to governments everywhere that bond vigilantism is not dead, and you have to be very careful about having your fiscal finances on a sustainable path. And I think obviously now the UK government has very rapidly reversed course. But I think that will have been noted everywhere, that we're now back in an environment where yes, public fixed income and sovereign debt is attractive, but boy, in a slow growth, high yield environment, you have to be very careful about what you do with your fiscal deficits.
I'm going to follow up on that because it's a point that's so in the headlines and people care about so much, right? The gilt crisis, and your word was bond vigilantism, which I really enjoy. We said that would be noted. Do you have a view on how? What's the long-term implication of that disruption?
Well, no, I think, look, we just gotten used to decades of governments being able to do what they wanted and to finance it very cheaply. And I think in an environment of high inflation and low growth, that was always probably going to be over. But that served as a very useful catalyst and warning sign to governments that they can't be fiscally lax.
Yeah, sure. Alan,
Maybe
thoughts? Go ahead,
sorry,
go ahead, Laura.
I
Please
just
jump in.
wanted to jump in on Michael's comment about, we expect governments to be able to deploy fiscal stimulus as they like, and as we think ahead to potentially slower growth in 2023, right? I think that's one of the key questions that markets are wrestling with is if you've got high inflation, still above target, and maybe less potential for monetary accommodation, but you may have some reluctance to use fiscal tools as well, given what we've seen in the gilt market and the reaction to the UK fiscal package.
Yeah.
Perhaps just a quick comment on that as well here. I think that this might be a short-term story, because once governments have opened the veins of like fiscal stimulus to their own, to households in their own respective countries, it's very difficult to shut off the valve. And therefore, I think that might be a little bit of a short-term story over the next year and a half. But when comes the time over the medium term for the next shock to the consumer in particular, I think that it's going to be very difficult for governments to resist the urge of, plowing more money into fiscal stimulus measures.
Michael, you came off mute.
I agree with that. Yeah, no, he's dead right. It's, I mean, look, we started with horizons, didn't we? Short-term horizon it's very difficult for governments now to do what they might want to do, but long-term, the pressure in the next recession when it comes will be for them to do exactly the same thing.
I'll ask a follow-up on that, right? This is in part lessons from the global financial crisis as well. The Fed and other central banks and national governments reacted this time in part the way that they did because of the experience that households had during the global financial crisis and some criticism that they got about the experience that households had during the global financial crisis. I wonder if any of you have views about this pendulum swing. Are we going to swing between these two endpoints? Are we going to stay at one endpoint, or is there a world in which we arrive at the middle? Michael, go ahead.
I can start with that. You're going to like this. It depends.
Very good. Have we found our one?
Yeah, no, and I think it depends entirely on inflation, because inflation is what stops both the monetary and the fiscal accommodation. And so I think, if we're thinking that inflation, and all of us talked a little bit about this, is structurally a little bit higher than it was prior to the pandemic, then I think both monetary and fiscal responses will have to be more limited.
Laura, I saw you come off of mute.
Yeah, I just wanted to jump in on fiscal policy and government involvement in economies, right? I think towards the compass theme around economic decoupling, we're now talking about, I guess maybe the phrase industrial policy, which has, evokes 1970s style, for better or for worse. But let's call it increased involvement, right? Whether it's through targeting particular areas to develop more in-house capacity, if you will, right? So it may be incentives, or maybe, not quite so heavy-handed, but in some countries it may be very heavy-handed kind of government involvement and industrial policy in order to facilitate, I think, longer run resilience in accordance with that economic decoupling theme that we touched on earlier.
Sure, thank you. JD, do you want to get in a word here before we go to Alan?
Well, I think what it tells me, the whole story here, is that while in the short term it's going to be a tale of softness, softer inflation, somewhat, still elevated inflation, but softer inflation and softer growth as well. So that tale of softness will morph as we head into 2024 and the ensuing years, into a story where it's like the impossible duality that certain market commentators have alluded to. So in the short term, tightening monetary policy to fight inflation for now and slow demand, whilst preserving financial stability, is very challenging. But even going forward, if you look over the medium and longer term horizon, if interest rates are doomed to be somewhat higher than they were prior to the pandemic for structural reasons, including structurally higher inflation, then it's also very difficult to preserve potentially financial stability in that type of environment. So something that investors will have to take into account as they plan for their portfolio allocations and manage those portfolios.
Yeah, I hear the subtext there also of the point Michael made earlier about fragility and how we might find our way into that environment. Alan, let me get your reactions to what you've heard from Laura, JD, and Michael, and also give you an opportunity to parlay it back to investment and capital allocation overall, if you see an idea there as well. Reactions?
Right, just two really high level points that I think can't be stressed enough. That point on time horizons, that difference that JD just mentioned between what it means for investors in the short term for governments and the more challenging long term with rates being at higher level. As an investor, as a company, when you're updating your capital market expectations or forecasts, this is utterly crucial. If you're an investor that has a certain time frame, a time period, it's vital that you compare like to like in that sense. And in another sense, when we look at the overall rate environment as a whole, with the levels that it's going to, the levels that it's been growing at, when you bake all these things into your expectations going forward, maybe it's more worthwhile to compare like to like, to take snippets and examples from past episodes in history. But maybe it's an opportunity to overweight those episodes a little bit as opposed to the fairly flat, fairly low past 10 years. So for investors, for companies, it's about the like to like comparisons, I would say.
Thank you, Alan. I'm alert to time, so I'm going to move us along to our last theme of the Compass report. This tension between resilience and efficiency. It's a subject that's especially timely for FCLT Global. Our member executives tackled this one exactly 3 weeks ago at a roundtable in Singapore. Their conclusion is that investors are perceived to place less value on resilience than companies because investors can diversify. But long-term companies still seem to be committed to resilience, and investors, especially owners, may be beginning to think about resilience as distinct from traditional measures of risk. Alan, I'd like to ask you quickly to first add a perspective, particularly from the corporate view about this balance, and then we'll go around the room with a follow-up question. Alan, how does it look from a corporate perspective?
Yeah, sure. I think it's a really delicate balance in that sense on the corporate side. So we all know the pandemic caused massive disruptions in early 2020. And if you recall back then, the US government had to bail out some companies in certain specific industries that were most impacted by the pandemic. Now, if the companies had planned for a little bit more resilience back then, maybe we wouldn't have had that discussion. The government wouldn't have had to act it. The result of the matter is they had a very thin buffer going in due to high levels of competition, redistributing a lot of their capital back through dividends and buybacks. Going forward, it does raise a really interesting question, though. Like, how much of a buffer is really too much? Too much cash on balance sheet, like we've seen in some aspects for corporates in the past year, isn't good either. You'd be better off investing in things like R&D, like CapEx, like your own employees. And investors, I'm sure, at the same time, are also going to begin questioning you, holding on to so much cash as a company. It might be a drag on returns, which I'm sure fellow panelists might have an additional view on.
Michael and Laura, I'm going to ask you both the same question. How, if at all, are you seeing financial markets and institutions deepening their resilience? And is it coming at a trade-off in either price or operational efficiency? Michael, can I go to you first?
Yeah, I mean, look, I think, look, resilience across. I put it in terms of resilience across a portfolio, and this goes a little bit to the asset allocation question that you talked about before. Is that in an environment where equities and bonds have gone down together, which does happen in the stagflationary environment, you then have to sort of think slightly differently. And you know, I would actually say as well that investors will have looked very carefully at the kind of companies and the kind of stocks that have actually done well in this environment. And you know, look, yes, they're going to be defensive, and yes, they might be cash rich. To Alan's point, the fact that they've gotten through this environment and have provided a hedge to your portfolio, I don't think that'll be lost on people and will carry forward.
Yeah, that language have gotten through this environment, I think is significant. Laura, can we get your views on the question?
Sure. I guess I'm thinking of it more in terms of resilience of different economies globally and different emerging markets. And I think certainly, some of the economies that are concentrated in particular primary goods have been better or worse off these last couple of years, right? We've seen divergence in terms of food and energy importers or countries that have more self-sufficiency or are net exporters of these things. And so I think you're seeing from a policy perspective globally across emerging markets, focus on building resilience so that your country can withstand these dynamics, right? So more diversification of supplies, whether it's in food or in energy space, or diversification of the business model that you offer to the rest of the world. And even in the Mideast, which we think of as being so energy intensive, those economies continue very significant investments to diversify their business models and their economies for the future too.
Thank you. JD, I'm going to ask you a more specific question, picking up something you mentioned earlier in the conversation, and that is the idea of relationship investing and what that might mean for resilience. Are there further thoughts that you would add on that or any reactions that you want to offer to Michael and Laura?
Sure. So indeed, relationship investing is just one way of piggybacking on that theme of making sure that you can accompany corporates in different types of transitions. But then again, on the private side, whether it's in infrastructure, real estate, or private equity, private credit, et cetera, there are a number of ways of continuing to support corporates in transitioning and in different ways. So firstly, I would note that as far as corporates are concerned, in terms of wanting to be resilient, definitely automation might be like an investment theme going forward as they want to become somewhat more resilient to trends that they can observe in the labor markets. From an investment standpoint as well, there's two things that I would note. It's all about energy. So the energy transition is going to be most potentially one of the two most significant investment themes going forward. And then the notion of going beyond just climate risk for corporates and long-term institutional investors as well. So biodiversity and the loss of nature is something that is getting an increasingly amount of time in the financial sphere, and it's probably going to be with us as a theme for quite a while.
JD, I appreciate that answer. Also, in part because it gives me a segue toward our last question. And we're going to do this as a lightning round because our time is nearly over. Michael and Laura, JD is just giving a view on the major emerging theme that he's paying attention to for the next year. And we would like to end on a look forward question. Is there a major emerging theme that each of you are also paying attention to over the coming year? Laura, I'll go to you quickly and then Michael.
I'll keep it very quick. I agree on energy transition, really a key focus.
Yeah. Michael?
Yeah, and climate solutions. So we have a portfolio that focuses on climate solutions, which actually has done fairly well this year compared to some of the ESG portfolios. So yeah, that's our focus as well.
We've reached the end of our time, everyone, and I want to take a moment, the last minute that we've held, to say thank you. You've been on a panel with Jean-David Tremblay-Frenet from AIMCO in Alberta, Michael Metcalf from State Street Global Markets, and Laura Sarlo from Liberty Mutual Investments. We appreciate each of you being part of this. I also want to take a special moment to recognize Alan. Alan has been the person who made Compass happen for FCLT Global, who called this into being and is now running it on a multi-year update, which is no small feat. Alan, on behalf of me and the organization, we really appreciate that leadership as well. Now, Alan can't do it alone. There's a lot of folks who are also involved who you don't see on screen today. Joel Pala, Noor Roble, and Vina Ramani are involved in our research function in helping to make this possible. Ross Parker, Brandon Costello, Jonathan Brown are involved in our communications function to make sure that you all know that this happened. And then behind the scenes today, we've had Demi McClure producing this webinar. Thanks to each of you as well. My last word of thanks is to everybody who joined us today. You're the ones for whom we do this. You're the reason why this exists. We really appreciate that as well. Here's my parting words. We hope that everybody has been informed and energized by today's conversation. You can download the latest version of Compass on our website. That is www.fcltglobal.org/FCLTcompass. I realize that there may be some folks in the room who are new to our organization. Again, we are a nonprofit research organization whose mission is to focus capital on the long term in support of a sustainable and prosperous economy. We hope that you'll look us up. Thanks to everyone and good day.